120% of GDP, almost 5 times higher. That is concerning. People need to pay attention. They need to take care of themselves because society is going to be unable to afford to take care of them. I think the third thing that I want to leave people with is on the opportunity side.
Hey everyone, welcome back. Today, Rick Rule is dropping some eye-opening insights on the opportunities in gold, the real impact of inflation, and what's really happening with interest rates. Rick reveals why gold is massively underowned and how a potential 4-fold increase in demand could shake up the market. Plus, he's not holding back on his thoughts about the Fed's role in managing the US dollar and why inflation is far more persistent than most realize. If you're interested in protecting your wealth and understanding the bigger picture, this is a must-watch. Let's dive in and hear what Rick Rule has to say about the future of your money. 2 risks and 1 opportunity. The risk is the fact that most people believe that they enjoy a real yield on US dollar-denominated deposits. When people in the United States look at inflation, and when people in other countries look at US inflation, they rely on the CPI. The slogan for that is that it's the CP lie. It doesn't measure the deterioration of the purchasing power in US dollars. It doesn't include, as an example, food or fuel. If you look at me, you can see that I like to eat. So an inflation index that doesn't include food is of very little use to me. But more importantly, it doesn't take into account tax, the largest household expense of most working households in the United States. When I calculate the increase in the price of the goods and services that I use to live, including government, which is neither a good or a service, what I see is that the purchasing power of my earnings and my savings is declining at 7.5% compounded a year, not 2.6. If I juxtapose that with the yield available on my savings in the U.S. 10-year Treasury at 4.3, rather than earning the delta between 4.3 and 2.6 as a real yield, I'm losing the delta between 7.5 and 4.4. And what that means to me is that the natural direction of interest rates is higher, or the natural direction of equity prices is lower, and that people need to pay attention to that. That's, I think, really the first thing that I look at. The other is related to it. It's the inexorable increase in government debt. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. On-balance sheet liabilities of the U.S. government in 2008 were about 25% of GDP. On-balance sheet liabilities of the U.S. federal government now are 120% of GDP, almost 5 times higher. That is concerning. It doesn't concern most people because they're more attracted to narrative than arithmetic. But people need to pay attention to arithmetic. Even more challenging for me, though, is the incredible expansion of the net present value of unfunded liabilities in the United States, entitlements. The Congressional Budget Office estimates that over $100 trillion in promised entitlements, Medicare, Medicaid, federal pensions, military pensions, exists today, which means that we're $100 trillion net present value behind the 8 ball, and nobody pays attention to this. We're trying to service $35 trillion in on-balance sheet liabilities and $100 trillion in off-balance sheet liabilities with a budget that is itself in deficit $2.5 trillion a year. We don't care because the trap hasn't been strung. The Japanese didn't care until last week. We absolutely have to care. People your age who believe, who are counting on Medicare, Medicaid, Social Security, if they're government workers, their pensions, need to understand that past is not prologue. They may deserve it, they may want it, but they're not going to get it. They need to take care of themselves because society is going to be unable to afford to take care of them. I think the third thing that I want to leave people with is on the opportunity side. Traditionally, during periods of time when
investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities. The primary beneficiary has been gold. Gold is underowned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially underowned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold. But I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant. Because I'm fairly vociferous and because I have a banking organization, I talk to a lot of lower level people at the Fed. And I have to say, despite my general anti-government bias, I found I like them, despite myself, that I've had some great conversations. The bias within the Fed as an institution is not to cut rates. The bias of the Fed is that the only institution that stands between us and the rapid deterioration of the U.S. dollar is the Fed. They see no fiscal leadership in Congress. And the institutional bias is not to cut interest rates because they see inflation as a much more persistent problem than Congress does. The top of the Fed is very political. They don't see their customer as the U.S. citizen. They see their customer as Congress. I believe that the real rate of deterioration of purchasing power in U.S. dollars is 7.5%. And I believe that savers deserve a bonus on top of the deterioration of the purchasing power of their savings. So I suspect if the market were left to its own devices, that the interest rate would be 7.5% plus 2 or 2.5%, which is to say 10%. I don't think the market likes that. Now, people want affordable housing, Julia. If you took the price of a first mortgage from its current 7% to 7% plus 2% plus 1.5%, and you had a first mortgage rate at 11.5%, you would have affordable housing. It's just that people want other people's houses to be affordable, not their houses. I believe in real interest rates. I think the right thing for the Fed to do would be to disband. I don't believe that manipulating interest rates is healthy. Now, manipulating interest rates is very healthy for an old, fat, bald, rich, smart guy like me. When you manipulate interest rates, you steal money from savers. You pay them less than you otherwise would for their savings. And you make those savings available at a discount to people like me who have access to credit and the experience to use it. Artificially low interest rates over the last 40 years have been an enormous subsidy to people like me who didn't need it, at the expense of working people who prudently saved for their retirement and found that the capital that they saved as a consequence of artificially low interest rates and inflation was insufficient to serve them in retirement. Mm-hmm. Artificially low interest rates stole from savers and subsidized spenders and subsidized investors. So for all of you who saved blindly, believing in lower interest rates, thank you for what you did for my net worth.
Thanks for watching. If Rick's insights got you thinking, be sure to like, subscribe, and share this video. We'd love to hear your thoughts in the comments below. Stay informed, stay prepared, and keep investing smart.